Hello and welcome to the simpleroptions.com video. My name is Don Kaufman. I'm going to be filling in for John Carter this evening. All right, so where to start in the markets? Well, I've always been a bit more of an index trader. That means, do I look at individual equity products? Absolutely. In fact, one of the first things we'll look at here in a moment is Apple. However, I have a tendency to not only be an index trader, but more specifically, I'm a bit of a quant. And what a quant means is I have a tendency to look at more relationships, things like implied volatility. I'm definitely an options geek, although I've traded, stocks, options, futures contracts. When it comes to different products, I do not discriminate. One of the things I've picked up on here, specifically in the SPX, implied volatility in the shortest duration, the options with 1 day remaining. It's jacked up to almost 17%. The next expiration out's down to about 16%. What does that mean? It means, well, tomorrow morning there's an employment situation coming out. And, typically you see a little bit more implied volatility. This has got a little more oomph to it. All right, the employment situation, well, seems to mean a lot over here. That is important, of course, in the morning. The employment situation is coming out before the markets even open. I know, you're thinking to yourself, well, what can I do? Just knowing about it is half the battle over there. I don't think it's like a tradable opportunity, per se, but no, there's a little bit more risk on the table because of the employment situation. The number doesn't mean anything. It's order flow when the markets open up could come piling in, and that's exactly why there's a little extra oomph, a little extra premium built into the options with only 1 day remaining. The VIX is a day late and $1 short. The VIX is looking at option premium 30 days out. I need to know, little inflections like what's my risk today, 7 days from now. And that's why I'm looking, again, specifically at the SPX, all right, and seeing a little bit more volatility kind of packed in there. All right, next, bond markets all over the world are seeing extreme levels of volatility. You should know that. Now, whether you track bond markets or not, why is this so important? I'll use in this particular case, I think it's a product that's a little bit more well accepted than maybe just looking at bond products. Like, I'm really comfortable talking about the ZB and the ZN, 30-year, U.S. Treasury futures and the 10-year, notes over here. And I'm pretty comfortable looking at the futures contracts. But if you're not, you can look at the TLT. The TLT is just, how do you say this eloquently, getting smacked in recent trading sessions. This is bond markets all over the world. It's not just the U.S. Treasury issue. The German Bund has been all over the place, extraordinary size and volume. What I also picked up on inside of this is quite specifically implied volatility. It's climbing in there. Implied volatility is the 77th percentile. All that means is, well, implied volatility in the last year hasn't been that much higher than it is right now. What that ultimately means is, well, risk is on the table. It's all about risk. Like, don't use the word implied volatility without using the word risk. They're synonymous with one another. How this plays out inside of the next few trading sessions will be pivotal, to the entire S&P 500. The magnitude of bonds, should never be forgotten. They are extraordinarily large in comparison to the S&P 500, or any market for that matter around the world. So what I always tell people, respect what the bonds are telling you. The bonds are telling you that there is risk on the table right now. And you go, well, nothing is happening in the S&P 500. Agreed. However, I've also picked up Asian markets are all over the place right now as well. Sometimes when I see markets moving around the world and you don't necessarily feel it here, I kind of think to yourself, well, what do those markets know that we do not just yet? And it started in the bond markets. Let's see if we can get through the next couple of days, again, without some kind of extraordinary volatility. One other product I do want to look at, last but definitely not least, is Apple. Quite specifically, Apple, although it had a little bit of a bounce session today, it's hanging on to the 125 level like it's grim death. Okay, Apple, ever since its earnings announcement, getting knocked back day in and day out. The number, specifically in Apple, you want to be able to hold, okay, is right around this 124 level. All right, Apple needs to hold the 124 level. If it does not in the next few days of trade, I think you see a lot more downside, okay, inside of Apple. Another thing I will point out, Apple, its implied volatility is actually extremely low. And that doesn't surprise me given the fact that earnings just came out. It's actually, though, in the 36th percentile, which is, again, a little lower than I think you'd normally see it, given the fact that Apple is off the 134 level down to the 125 level in just a few trading days. Again, look for Apple breaking below 124. If it does break below 124, I'm pretty sure we're going to have some more follow through to the downside. Thanks a lot, everybody, for joining me for today's video, and please also join me, if you would, for the upcoming pairs class. That's this Saturday. It's simplerstocks.com/pairs, where I'm going to talk about quite extensively using, okay, a number of different strategies to trade, not so much about market direction, but trade pairs. That is, using stocks, okay, or options within a similar sector, and looking for what they call convergence and divergence. Direction can help you know more in pairs trades. It's all about relationships, and I'm just the quant to be able to teach it. Thanks a lot, everybody. Have a good evening. Bye-bye.